Hey, good morning, everybody. Today is just a great day. I get to visit with one of the old friends that I have. Yes, I have two friends, so don't laugh. This is Chris Atherton, and he is the president and CEO of EnergyNet, and we are going to have a great chat. Chris, welcome. Thank you very much for stopping by the podcast.
Hey, great to see you, Stu. This is going to be a lot of fun. I haven't talked to you in a while, and miss you, good bud.
Oh, I'll tell you, we had so much fun. And I got to just kind of give a yell out to all of your EnergyNet staff. I have enjoyed working with them in the past, and it makes your job a little easier when you got good people working with you.
Oh yeah, definitely. We got a great team and a bunch of hard workers and dedicated folks. So thank you for that. I'll pass that along to them.
Well, hopefully they'll see it.
Yeah. Hey.
One of the things that Chris, you and I were laughing about is thought leaders. And I went to Oklahoma State. Now I've got a Texas license plate. So I still got smarter when I went across the border. But we were laughing about Doomberg. And I absolutely love Doomberg. And when you sit back and go, I thought it was a typo when I first saw this coming out. What do you think about some of the topics that they come up with?
I'm curious of who the real identity is. I don't really care that much, but I am curious. But they're very much just on point in the intersection of energy and politics and geopolitics, and a lot of the things that are that are a little bit more nuanced, a little bit more complicated than what can be in a soundbite or a 1.5 minute clip on the nightly news. I do have to set aside time when I get my Doomberg articles in the morning, or when they come out. I know that I'm going to have to spend some time because it's going to take 30 minutes or 25 minutes to read it and digest it and understand it. But almost every time I do, I want to forward it to 10 people, or I want to send it to my father, or my coworkers or my friends.
Right.
Are you aware of what's going on here? Because it is so kind of pulling the curtain back, on what's really going on. It seems very truthful and very honest.
I did see him on the little, is that a turkey or chicken or whatever he is?
Green chicken.
And they had him shaking and he was talking on a podcast.
Oh yeah. I've seen that. Yeah. It's like an animated and the chicken's talking.
So you're one step above Doomberg, because I asked you to come on as an old friend just to say, hey, and get caught up. So consider yourself above Doomberg.
Yeah.
Chris, being an industry expert, you get to see all of the M&A activity with EnergyNet that's out there. You really got a finger on the pulse. I got two questions for you. Tell us a little bit about what EnergyNet does, because that sets the stage for why you're an industry expert. And then we'll go into the market, if that sounds all right.
Yeah, certainly. Just get some background on EnergyNet itself. Is that we're a oil and gas two-sided marketplace. So what we're doing is bringing assets to market really all over the lower 48, some Canadian assets, some Gulf of Mexico assets. In a given year, we probably sell 2,000 individual transactions.
Wow.
A given year, maybe the volume, the aggregate sales volume is probably between a little bit less than $1 billion to maybe 1.5 billion. We've had some big years where we were in excess of $2 billion in assets sold. But we really get to what's fun and what's interesting is we really get to see and deal with the full spectrum of industry participants. So we sell assets for major oil companies, for large independents like EOG and Oxy. We're currently selling some assets for EOG right now. Marketing those assets on their behalf, but private equity sponsored teams and companies. There's a whole mineral and royalty space that's very active and dynamic. There's a non-operated working interest space that's very active and dynamic.
Right.
So sometimes it's the assets that we're selling. It may be a major or a large independent that's selling assets that they've fully developed.
Right.
They're not going to really raise the bar for them anymore, going to be a big moneymaker for them anymore, but they're better suited in maybe a smaller operator's hands. But then the flip side of that, there may be other opportunities where a new play is emerging, where so it's a kind of a land grab to lease those acres to drill those wells, and that can be in those cases it could be a anybody and everybody that's wanting to get in on the new play. So sometimes it feels like it's for us, we're helping facilitate sales, transactions, asset sales down the food chain. Right. And sometimes it's kind of up the food chain where a company's building their position to potentially sell to a bigger fish up, upstream. But it's always dynamic, and for us, for doing it so long, you mentioned it in your kind of opening remarks, but having the pulse of the industry, doing that many deals, dealing with the full spectrum of industry participants, really does feel like we have the pulse of the market, just a sentiment of kind of what's going on and what people are thinking and why they're, if they're bullish or bearish or optimistic or pessimistic. But it gives us a real, like, just for example, like, since we've been doing this for 20 years, we were doing it before the Barnett Shale was happening. We were doing it before the Haynesville was happening. There was all of a sudden the Delaware Basin was more than goat pasture. It was the hottest zip code out there. And it's fun kind of being at the forefront of some of those things and seeing them happen in real time. Or sometimes you don't realize they happen in real time. You have to look in the rearview mirror to kind of have a better understanding of what was really going on.
Right. Well, as you sit back and take a look, you've got the finger on the pulse. You're understanding everything going on. Let's back up a little bit to just what happened with Congress and beating up the oil execs. I mean, good grief. You bring these guys in and you say, will you not give any money back to your investors in increased drilling? And every single one of them go, no, I will not cut my investors back their money. And yes, I will drill more. They were beating them up and the guys were really good. But when we have the CapEx being impacted by inflation, there's lower money coming back into this. Where do you see the big boys in buying assets? Are they going to be able to get out there because their investors are demanding more money back? And so do you see them increasing their CapEx spending to buy more products or buy more leases or?
Yeah, a little bit of both. I mean, I think that kind of, the upstream industry, the shale revolution was a big boon for consumers. We got very low prices because of the supply, and it was really a technological miracle and put, U.S. energy independence and security really at the forefront. So all that happened, but then there was, every dollar they made, they were putting back, the oil and gas companies were putting back in the ground to drill more and more wells. And then finally, the investor community said, hey, we're getting burned here. We're not getting any money. This isn't how it's supposed to work. You have all this great inventory, these great assets, like let's use them and let's send some money back to me. And let's have very no growth or moderate growth for a period of time. And this was before the Ukraine. This was before really even Biden. This was like, the investors were saying no more just, spending all your money on drilling more wells, more production. We want these to be profitable companies. And, CEOs at Diamondback or Pioneer or Chevron or Oxy heard those investors loud and clear and said,
"You bet they did.
What we will do from now on is we won't grow as fast, and we will, send dividends, or we'll do share buybacks to return that capital that you invested with us." And you have Scott Sheffield with Pioneer saying, if oil goes to 125 or 150 or 200, we're not growing because we told investors we're not growing. And we're going to hold our word to our investors. They provide the capital for us to operate, and what they're demanding right now is a return on some of those investments and capital, and that's what we're going to do. It is
absolutely. Isn't that great?
Yeah, it is great, and they're doing a fantastic. Some of these companies are, they could, if they cash flowed themselves for the next 3 years, they could, that would be the entire value of the company. They could buy what the company's worth right now just from 3 years worth of cash flow.
Well, when we take a look at Exxon bought back bazillion dollars, that's a technical term, Chris, bazillion dollars of shares. They made 10 billion in profits, and they bought for whatever the numbers turned out to be. Chevron said they're only going to increase their CapEx, I believe it was 20%, but I'm hearing rumors out there that the drilling costs are 50% increase.
Right.
You can see where I'm going with this is we're not going to be able to drill our way out of the high prices, are we? Do you think?
No, I don't believe so. I mean, right now, just the stage is set by a lot of different things for higher prices for a significantly longer time, and part of it's
Right.
capital restraint. There hasn't been capital put into the industry. Some investors have just gone away and sworn off the
Right.
fossil fuel industry, or sworn off shale companies that weren't good stewards of their capital for a period of time. You have a regulatory environment where every signal, if you're looking for a signal, it's saying don't drill, stop drilling, we're putting you out of business, this is
Right.
the past, not the future. This is and so why, if I were an investor, it'd be difficult for me to say, all right, I want to put billions of dollars into this project that's going to take 10
Right.
years to complete, that should make money after 10 years or after 20 years, but the regulatory environment's just saying don't do that because this industry won't exist, or we're going to put them out of business. So that's, and then they're asking why are prices so high? Drill more immediately. So it's
Yeah.
a
And
very
everybody needs to
a
go,
lot of moving parts.
and everybody needs to go in an EV car, but there's no minerals. So
Right. But I would say, you asked a question, will these publicly traded companies buy assets, or will they
Right.
maybe use cash to drill more? I think that there already has been considerable consolidation. I think it will continue to happen. So you had
Right.
Conoco buy Concho, you had Pioneer buy Parsley, and then Double Point,
Right.
Devon by WPX. So a lot of very large deals. Oxy buying Anadarko.
Right.
So I think that will probably continue. I think some large publicly traded E&P companies are likely a little skittish on buying making another huge merger acquisition while the prices are so high. They don't want to be perceived as buying at the top. But I do think the publicly traded companies will ultimately need to replenish their inventory.
Right.
And the way to do that is probably buying a smaller company or buying other assets.
You led right into my next question, because if a publicly traded company is looking to get new property, doesn't it make it a little easier to get by and buy assets that are already producing, so they get free cash flow when they buy it, kind of a thing?
Oh yeah, and that's a big consideration these days, because there was a period of time where companies with very little production, but all this inventory, all this acreage, were selling for really astronomical prices. I mean, there was a company called Q-Star, for example, that sold for billions of dollars, and they had 4 producing wells. And but the company that bought them needed the inventory, and they had great inventory, but billions of dollars in 4 producing wells is pretty insane. Now I think buyers, they want to buy an asset or buy a company that already has a significant production base, but also has some running room. There is a fine line, or a line. A large publicly traded company probably wouldn't just buy only a production deal. That just wouldn't get them excited. But they do like buying production because it already cash flowing in. Then they have the other inventory to drill. Maybe it funds itself. But I think some of these private equity sponsored companies, and the way I think about private equity sponsored management teams, is they're building something, a product that hopefully a public company will want to buy at some point in the future, that they can take it to the public market. So they're using a little bit more risky dollars, using a little bit more, maybe it's the fringe of the core play, maybe some new technologies, taking a little bit more risk, but they're building something, a portfolio of assets that hopefully a public company will want to buy. And because of the turmoil in the upstream A&D market, M&A&D market, and the capital constraints, there was a traffic jam, a log jam for quite some time, where just the food chain of A&D wasn't working. The public, the private equity companies had built these massive portfolios and had this great acreage and rock and inventory, but the public companies weren't buying it. So it was up to, it was kind of a decision for those private equity sponsored teams they say, we're just going to mow down wells. We're going to mow down wells and turn inventory into cash that we're going to return to investors. But that's a fine line, because if you're a big company, a private equity company that you're still wanting to sell at some point, you want to have some inventory left that a public company
Right.
will be able to exploit and use their own. You don't want to be a full just PDP company.
So as we're looking at this, and you mentioned that you had been working long enough, Chris. I mean, I'm older than you, so I can kind of like Moses and I are buddies, but you know, before in the Haynesville, you know, it's mostly natural gas. And then
Right.
you take a look at the Marcellus, and I don't understand why our East Coast is buying LNG from Norway, Trinidad, Russia, you know, and they've got what, 4 LNG degasification as they come into the import, but they got the Marcellus right there.
It's in their backyard and they just don't have access to it. They ship all the gas somewhere else, and they're buying, Boston is buying their gas from Trinidad and Tobago and liquefied tankers, LNG tankers, and they have the Marcellus right there.
Isn't that nuts?
It's just politics gone wrong.
And EnergyNet is all over the country now. Are you seeing much activity up in the Marcellus?
Yes, we are. You know, with some of the really, you know, EQT is huge up there, and Taro is really big.
Right.
You know, there's a lot of interesting things going on with, you know, Coterra, for example. Cabot and Cimarex formed to have Coterra. They have a, you know, huge position in the Marcellus. So a lot of, I think what they would like to do is they have this ample resource. They would like to be able to turn that to LNG and ship it all over the world. And that would be, you know, really good for the environment, actually, if they were to do that rather than burning coal. But you know, you have to get through the hurdles to get there. But the Marcellus is a huge resource, and it's just it's kind of trapped right now a little bit. You have to get the gas out and be able to take it to market. But there's demand for it, but it's just trying to get it from point A to point B, and it exemplifies the issue when you can't even get it from, you know, Pennsylvania to, you know, to Boston.
So we've seen some really big activity up in the Permian, and that's just, you know, that's like the mother lode for you, isn't it? I mean, that's still most of your
in terms of deal flow.
Yes.
In terms of, yes. So still a lot of deal flow in the Permian. Probably for us, a little kind of balance between the Midland, Delaware Basin. We've done some legacy type deals in the Central Basin platform and Northwest Shelf. We have been seeing quite a bit of activity in the Williston Basin and the Bakken.
Right.
And then some of these basins, for example, the Haynesville is very concentrated, and so is the DJ Basin. There's you know, there's kind of 5 or 6 main players, so that's great for, you know, consolidation has occurred, but what it creates is not a lot of deal flow activity compared to, you know, East Texas or the Mid-Continent or different areas where there's just hundreds and hundreds and hundreds of operators, and it's very fragmented. But like in the Haynesville and the Marcellus, and becoming more so in the Williston, you know, there's some dominant players in those areas.
Okay. Speaking of knuckleheads, when we sit back and we look at California, I got to pick on California. It's an open season, you know. I mean, it's kind of like fighting an unarmed opponent if you enter into a contest with them. They're buying 25% of their oil over the last 5 years from Iran. Okay, that's a sanctioned country. They don't care. They're buying all the oil from the rainforest. So, you know, they're not green when they're buying this. And you've got some of the best fields out in the world, right there in the Bakersville area and all that kind of area in there. Are you seeing any activity out in that knucklehead part of the world? Let me rephrase that. What do you think about it?
Typically, I mean, like California has some great assets, great oily assets that people would really, in an alternate universe, would like to own or acquire. But it is, you know, it is interesting to, you know, we talk to a lot of investors and operators just, you know, day in and day out. Is, you know, what are you looking at doing? What's your strategy? Where are you focused? And, you know, it is funny, the things that, you know, we're buying everywhere. We'll buy anywhere in the country. Well, of
Right.
course, not California, and probably not California or Colorado. And
Right.
so the places with above ground risk, we have enough risk
Okay.
drilling for wells below the ground, but above ground risk is another wrinkle that a lot of people don't necessarily don't want the headache. But you do
Right.
have companies, like Sentinel Peak and CRC. Amplify Energy has California assets, but once you're there and kind of probably know the ropes and are ingrained a little bit, you can operate it. It can be difficult, but there's not as robust A&D activity, M&A activity.
Right.
And
Which
so
is a shame. I mean, you
Yeah,
got,
right.
again, what a resource there. And it's
Right.
a lot less carbon neutral activity in order to get it from a pipe there down the road instead of bringing it in on tankers and having
Right.
pollution and everything else. Am I logical or am I Texan?
I think it's logical. I mean, it's very difficult to I guess some of the environmentalist climate issues like that. I'm an avid hunter and fisherman and outdoors
Right.
person. I want a clean environment. I want a clean environment for my children and grandchildren. I don't think that the solution isn't cratering everyone's economy and
No.
sending everyone back to the Stone Age. We're adaptable people and resilient, and we'll make things make things work in the long run. But just some of the alarmists and things like that are a little troubling.
Well, the people forget that the reason that a lot of our natural resources are being taken care of is because the hunters and because the fishermen, they go out and they pay for it. They're very respectful, just
Right.
like you said, of the outdoors.
Right.
And I believe in, hey, carbon neutral. I think we need to get there. How we get there is all about the right plan. Let's use whatever power we need to
Right.
use. I don't care. Let's let the market decide with
Right.
the least amount of impact, and let's get the lowest cost kilowatt per hour to everybody.
Right.
And that means natural gas. That means oil. And I mean, that
Nuclear.
seemed, yeah. Okay. You and I just sold each other on another couple million acres. So what's coming next around the corner for EnergyNet?
Couple different things. This year we've been off to a fast start and selling some higher value deals. So although we've been in business for 23 years,
Right.
in the past say 5 or 6 years, we've completed about maybe 160 individual transactions between about 10 million and say $250 million in value.
Wow, nice.
This year we've done or in the past 12 months we closed some about $100 million deal for Chevron and the Central Basin Platform, another large, probably
nice.
75 or $80 million deal for a private seller or a privately held group, and the Utica Shale. We did another deal for Comstock Resources in the Williston for about 154 million. We have some larger multi-basin nationwide royalty and mineral packages that we're bringing to market. And we have we're coming to market with some North Texas kind of PDP heavy with some development upside that's pretty chunky and sizable that we think will probably be a $50 or $60 million type transaction. So the EnergyNet Indigo portion of our business is, I guess, it's marrying the technological platform and outreach, and we have EnergyNet has up to 45,000 registered buyers with about $20 billion in bid allowance and dry powder ready to bid on assets, approved bid allowance. So that portion is teed up and ready to go. So we've kind of married the technology and the platform itself with some really high caliber engineers, geologists. So our technical team, we're building up to be kind of energy investment bank class analysts, and so we're kind of going that direction. So that's been allowed us to move up market and win and execute on some higher value deals. So we've been excited about that, excited about some of the deals that we're bringing to market. And then our government resources business, you visited with Gus before. He heads that up and just doing a lot of really good things. We're currently working for about 16 or 17 different government agencies We facilitate
Nice.
oil and gas lease sales, but we also do kind of other energy related commodities or resources that these state or federal agencies own or manage. It may be geothermal, maybe lithium, maybe
Nice.
renewables, wind and solar. So we're excited about those opportunities, and that can be a real game changer for us as a company.
So EnergyNet is truly energy. You just ain't oil and gas.
Well, I'm oil and gas focused, but yeah, kind of all of the above, and the energy side of it, and yeah, well, and while we stared into the abyss of April or March or April of 2020, we're like, do we really want to be in the oil and gas business only? So it was nice to have some other things to consider and to chase after.
And that goes back to my comment. It's energy. Who cares?
Right.
I mean, it's about getting the lowest cost kilowatt per hour to the people.
Right.
And anyway, but what's next for you, Chris?
For me personally, I don't know. I'm having fun. I haven't had felt like I had the wind at my back for 2 or 3 years now, just with the turmoil in the upstream oil and gas industry.
Yep.
I'm happy and battle hardened that we've weathered the storm and made it through. But we have a really good team. We have about 50 employees now. We actually have some interns in the office this summer, which is fun. The new bloods, but expanding our team.
Nice.
So a lot of good stuff, exciting stuff in the works with the higher value deals that we're doing on the EnergyNet Indigo platform, but also in the government resources space with some of the renewables and wind and solar and things like that. So pretty excited about it.
Oh, Chris, I'll tell you what, thank you for stopping by the podcast today. I have had an absolute blast. And
yeah, that's great.
I want you to reach out to your guy. In fact, I'm going to reach out to him and say hello to.
Yeah,
it makes a difference. You would not be running down with the wind at your back if you didn't have good people. So,
yeah, some really great people. It's always great to see you, Stu, and it's been a lot of fun.
Sounds great. Thanks. Talk to you soon, Chris.
Okay, thank you.